Subramaniam, Chief Investment Officer, CIO at UTI AMC. Vetri, good to have you on board. Just going by the kind of moves that we've been seeing in the markets of late, just wanted to understand your outlook on where valuations, how they stack up, and whether or not you believe that consolidation is the way to go, at least for the next few months.
Yeah, hard to predict, whether it will consolidate, what it will do, but it's always good to know where you are in terms of valuations, because the starting point in terms of valuations typically has a very high probability of indicating what kind of forward returns you can earn. At the current level of valuations, I'm talking more about the large cap Nifty 50 kind of valuations. The market is rich, though I would not categorize it as extremely rich. In fact, early in November when the markets came down, our asset allocation strategies actually used it as an opportunity to raise equity exposure. But I would just sort of say that at the current valuation level, investors should have a fairly muted expectation in terms of their near-term returns, let's say over the next 1 to 2 years.
We should be hoping for fairly muted returns going ahead. But hi Vetri, good morning. This is Shrishti also joining in. But given the allocation and given the movement, Vetri, with the large cap stocks appearing fairly above that fair value, what should be your allocation strategy looking like at this point in time? Do you believe that the large caps still have sufficient potential for an upside, or would you like to bet on the mid and the small cap end, and you believe that there's more headroom for an upside from these levels as well?
Yeah, good question, Shrishti. Actually, it's the other way around. The mid and small caps in aggregate are actually very richly valued, so much so that, I'd be very nervous about the kind of, expectations that people have from that set of companies in aggregate, because, mid caps are trading at a massive premium to large caps, and very unusually, I'd say in the past 20 years, I've rarely seen small caps in aggregate trading at a premium to large caps, but that's actually happened. And therefore, I would actually argue that the implied expectations that people have from this aggregate set of companies is just too aggressive. And which is why actually the large caps, even though they are rich, are actually far more comforting in terms of valuations. In terms of asset allocation, just to be clear, we are sort of in the neutral zone, and I'm referring to our asset allocation model, which we use in strategies like our balanced advantage and our multi-asset allocation fund, because those do take asset allocation calls. Now, this might not be right for any individual investor who has a very different set of financial goals, but just to make the point, we are in that neutral zone. The market is not particularly cheap, neither is it nosebleed expensive.
Okay, fair enough. I wonder what the stance is when it comes to earnings, because, it has been a bit disappointing. Can't take away from that. But do you believe concerns when it comes to the slowdown that we've seen within the consumption space as a whole are likely to linger into the coming quarters?
I think that's the guidance we are getting from companies as well, and just to step back for a moment again, going into this year, what we were always saying is that if you've got a single digit year, in terms of single digit nominal GDP growth outcome for the year, then for companies to get margin expansions will be very difficult. And what we are actually seeing is weakness in revenue growth, single digit nominal GDP growth at the aggregate level. And therefore, as a result, companies are really struggling in terms of holding on to their margin levels, because remember, last year's margins were extremely elevated. And therefore, I would argue that even the current estimate of 8% earnings growth for 2025, with half the year done and looking much weaker, I think there is a risk that even that 8% growth number might get cut further by the end of this quarter.
Right, but Vetri, that's interesting to see indeed that the BFSI space has been doing well off late, because yes, the stocks have corrected from their highest point, but given the market volatility, those stocks are seen to be recovering. Some of the sector leaders are also doing pretty well. So how do you assess the sector's growth prospects related to the current valuations, and also how do you manage the potential risk in this particular space?
Sure. Good question. Eventually it's very hard to figure out what will necessarily do well over the next 6 months to 12 months. Our role as fund managers and investors is to identify where do we find the combination of healthy fundamentals, reasonable growth potential, and reasonable valuations. And when I look at that combination, really one of the only sectors where we think the case is now very strong is in the BFSI segment, particularly led by banking, but I would say even insurances, including falling into that category. So this is an area where we think there is a long runway of growth. Credit to GDP, including in retail, is quite low in India compared to the potential we have for income growth and eventually for credit to grow. So this is the one sector where we think the scope for absolute positive returns is actually quite good over a 1 to 3 year time frame. I've felt this way for the last 6 months. I would still not say that the sector has delivered on that expectation, but there are some headwinds, but it's only when you have those headwinds that you get the valuations which are attractive. So I would say this is the right sector to which you want to be positioning yourself for a good outcome over the next 1 to 3 years.
Vetri, I wonder what the outlook is on some of these quick commerce players, because day after day we're reading the headlines of either a fundraise or somebody coming out with a new offering. And, the space is really hotting up. Just as a whole, maybe quick commerce players, listed names, new age tech, your take.
Well, I don't think there is a simple, one size fits all answer to that. We've been investors in some of these companies when they went in for their IPOs. We've held on right from then. We've added to positions in some of these strategies. We actually run a innovation strategy where some of these D2C consumer tech and consumer platform companies are large exposures. I think there is a good, sort of opportunity for many of these innovative businesses to grow over the next decade. But you've also got to be cautious when there's too much noise about these companies and there's too much noise flow coming in every day about, as you said, fundraise or somebody talking about growth. So I'd be a little concerned right now that maybe there's just too much talk, but don't lose sight of the fact that I think innovation is a great strategy to be investing in over the next 5 to 10 years.
Believe that you have flagged off some concerns related to the valuations all of these capital good and the power utility companies have been holding. So wanted to get a sense that what exactly could be the likely risk for this particular sector, and also correct me if I'm wrong on your take on given this space. But I also wanted to understand that how are you positioning yourself to navigate these sectors which for now having a lot of investors interest.
Good question. Easy one is utilities, where eventually this is a regulated business. So returns in terms of return on capital is healthy, but it's in the mid-teen levels. Now, for those kind of businesses where the outlook is in terms of mid-teen ROEs, to be paying such a hefty price to book multiple, I think is quite debatable. There is excitement about the transition to green energy. But remember, in utilities, nothing changes in terms of return profile. All that changes is the segment in which they will be investing. So I would be wary about the mismatch in utility businesses between their potential return on equity that they would enjoy. Because as I said, this is a regulated business. You can't be paying the kind of valuation multiples that you are just because there is a green transition happening, because that green transition actually involves large amount of investments, but not necessarily a change in return profile. As far as the industrials are concerned, I just think the absolute level of valuations there is quite absurd now. And the fact is, if you've got a little bit of slowdown on the consumption side, I won't be surprised if with a few quarters lag, some of that slowdown gets reflected in the order books of industrial companies as well. So I just think that, despite the overall positive outlook for, investment spending in the economy, the starting point of valuations is just horribly wrong. And that's why I'm happy to stand back from capital goods.
Any sectors that you believe that right now would be a complete avoid?
Yeah, I mean, I'd pretty much talk to what I said, which is the capital goods area. That's the one that, we'd avoid just given their crazy sort of valuations. And in the mid cap and small cap space as well, I'd be a lot more cautious. I think the main thing, rather than just talking sectors, what I would point to is that this is the kind of market environment in which we need to stand back. We need to move away from the narratives that are being, sort of told to us. We need to step back from the storytelling that's happening in the market and really starting to focus on, does this company have cash flow? Does this company have a large growth opportunity where they can deploy capital and earn a significant premium to cost of capital? So I would say move away from narrative driven investing to a focus on cash flows and return on equity, because this is a very dangerous environment when valuations and narratives take over.
Good to know. Thank you so much for joining in and hope you have a lovely weekend. All right, let's
Thank
get a
you.
move on. A quick check-in as to what the indices are up to.
If you like this video, then like, share and subscribe to ET Now.